First, there was the US Fed, then there was China, now potentially in the next 2 weeks, the European Central Bank. Now, what am I talking about? Well, we'll get to that in just a moment. Welcome to today's FatTel Daily video. I'm joined today by Ryan Dinse. Ryan, welcome, mate.
Hey, Woody, how are you?
Now, do you want to tell us what's going on, what I'm referring to in my intro?
Yeah, so interest rates, basically, in a nutshell. Although our own Reserve Bank last week declined to reduce rates, they stayed on hold and they cited that, they want to see inflation come down more.
Yeah.
If you look beyond our shores and you look at what's happened in the US a couple of weeks ago, the Fed probably surprised the market by doing a 0.5% cut, which was probably a little, most people were probably expecting 0.25%. So that was the first sort of thing that got financial markets going, hey, what's going on here? That's a bigger than expected cut. Is that good? Is that going to juice the market? Is that bad? Is that a sign they're more worried about things and they're trying to get ahead of it? And then this week you had the Chinese authorities, the Politburo, announce a similar 0.5% cut in one of their key benchmark rates, but they did a lot more. It wasn't just being a centrally planned government, essentially. You could argue the Fed is as well, but the Chinese, they came a whole raft of different proposals. So they had a cut in interest rates, which is generally good. They had a cut in the reserve ratios required by banks, which basically means the banks can lend out money without having to hold as much capital. So that's, again, stimulatory. Then they had a whole bunch of spending announcements. Some were proposed and some were definite, but if all the proposed spending plans go through, which are focused on stuff like healthcare, housing, sort of 50-50 between consumption and investment. So some of it's housing and that infrastructure stuff, and another of that spending is focused on driving consumption up. But that amounted to around about just over $2 trillion US if that all goes through, which is a fair chunk. That over 2 years that would be 4% of China's GDP. So that's a lot of money potentially coming in. You had a few other little tidbits in there. You had a decrease in the deposit required on a second home, so from 25% to 15%. Again, trying to stimulate housing. And the one that caught my attention was a note that said they were giving some money accessible to funds, insurance, and securities dealers, allowing them to essentially borrow money to buy stocks. So if you want a clear signal of a central authority trying to juice the market, there you have it. You're basically saying, hey, insurers, fund managers, hey, here's some money, here's some cheap money, go and buy some stocks with it. I mean, the Fed and the US authorities do that in more subtle ways, essentially. Sometimes they buy stocks and sometimes they reduce interest rates to allow other people to buy stocks. The Chinese authorities are doing it too, but they're doing it pretty explicitly. So yeah, that's what happened last week. And then, as you said, the EU the expectations they're going to start cutting rates more as well. They're doing it for a position of weakness. They've had a bunch of bad economic indicators, especially coming out of Germany, which is, I don't know if you read the headlines recently that Volkswagen announced like 30,000 layoff in employees, and Volkswagen's one of those huge, iconic German industrial companies, and they're obviously struggling, and there's a whole lot of that German industrial base is struggling right now. So with Germany struggling, the EU is probably going to look to cut and stimulate their economy in certain ways too.
Well, as you described it in your article, it's the great, and I really like this, by the way, the great global print is on, referring to basically, just providing more liquidity. As you say, in China alone, it's the equivalent of $2 trillion, which it's got to go somewhere, right?
Yeah.
Just quickly before we discuss where it could potentially go, do you think the RBA is likely to be next, or something that you pointed out in your piece is that it really doesn't matter, really, in terms of the global...
It doesn't matter in terms of the broad narrative of, the three economies we just mentioned make up more than 50% of the global economy. So from an economic standpoint, we're a commodity producing nation. And if China's printing, that's obviously good for us, especially if they're going to dedicate it to housing. You saw last week iron ore, copper, starting to bounce. Our colleague Greg Canavan was mentioning this morning that he saw a big rotation out of bank stocks and into commodity stocks on the back of Thursday's announcement, even as late as Friday. So that is good for us. Now, will the RBA cut? I think they will. I think they'll join the party. You've got to remember, when the US started increasing interest rates and other countries followed suit, we were pretty slow in following that. And some people say we were too slow. I think the reverse will be true as well. We'll probably be a little bit slow in cutting rates on the reverse side because look, we're a beneficiary from this growth. So we can probably the RBA is thinking we can probably wait to see if any of that has an immediate impact on our economy because they don't want to cut and then the economy starts heating up again and then they get inflation again. So they're probably just waiting and seeing, but I still think they will. Generally, we will follow the direction. New Zealand cut, for example, a few weeks ago, another smaller sort of economy aligned with global growth. So I think we will, but the timing of it is uncertain.
So you discuss now the concept of risk on trades in sectors like, first of all, copper, uranium, and tech. How do you see these sectors performing relative to each other as sort of this global liquidity increases? And are there, I mean, they're the ones that are going to potentially be the beneficiaries, but are there any potential risks or outliers that investors should be aware of?
Yeah, look. So in the piece, I actually just chose like certain sectors. There was no rhyme or reason to choosing them. I was just choosing speculative sectors that weren't really linked on a fundamental basis. So copper, uranium, tech, high yield debt. They're all rising. Some started rising 3 months ago. Some started rising this month. But they're all sniffing out this money printing, this liquidity, because especially when interest rates come down, when you've got more money shuffling in the system and you've got interest rates coming down, other players in the market, people who have got money in money market funds, for example, there's about $6 or $7 trillion in money market funds earning interest rate. As interest rates come down, that starts looking for other opportunities because they're getting less return on their money in these money market funds. And you can already see the money flowing out of those sectors into the more speculative stuff. And that's because they're rightly saying, or the market's rightly saying, well, all this money's coming into the system and it's got to go somewhere. Interest rates are coming down, so money's going to come out of there. Well, where's it going to go? It's going to go to things that naturally benefit from lower interest rates. So, commodities, for example, if China is going to spend a ton of money on their economy, well, commodities make sense, doesn't it? Uranium, you've had some big stories about uranium with AI companies basically going to invest in uranium nuclear facilities because they need the energy. There's a 3 Mile facility in America going to be restarted. I think that was in conjunction with Microsoft. So the world is going to the nuclear power, and big tech with the AI energy demands of AI are going to drive that, and that's happening. I know we've got a bit of a debate here in Australia about is nuclear for us or not. The rest of the world's gone past that. They're especially these high tech hubs that want AI, they're moving to nuclear power.
And that's going to drive uranium demand.
And that's going to drive uranium. And you're seeing the money flow into that as that narrative's helping, but also because the money print is looking for these growth areas. You know what I mean? You're printing money. I'm getting less in the bank, essentially. I want to find growth. So uranium looks like a growth story. Nuclear power looks like a growth story. Big tech, obviously had a ripper year, and then it's had a bit of a correction over these past, 3 to 6 months, I suppose. But you're getting signs coming out last week with various earnings releases in America that the AI story, the investment story, at least, is still going hot. So that has seen speculative money come back into these AI stocks and these big tech stocks. And then the high yield credit one is an interesting one that I chose because high yield sort of corporate debt is considered risky when the economy is struggling because obviously the chance of default is higher, but we're not seeing that yet. We're seeing the price of this high yield debt, the index anyway, going up because people are still confident that there won't be defaults, and as interest rates come lower, the high yield debt becomes more attractive. So if you look at all those sectors, they're just little clues that money is rotating out of safe stuff and into riskier, more speculative, growth orientated stuff. And look, barring a catastrophe, that's what always happens every time the big economies print money. There's a chart I share in today's piece that shows that there's direct correlations you can see of money supply and asset growth. The stock market, there's a chart I've seen before which basically shows the US stock market is just a function of money supply. If you look at the growth over the decades, it pretty much follows just the increase in the money supply, what they call the M2 money supply. It just tracks it almost perfectly. And it's really a simplified way of looking at markets for an investor, and it just cuts away all the fluff. You know what I mean? People will argue to death about, is the Chinese economy bad or good? Is unemployment going to come? Or interest rates going to go here or there? What sector's doing well? What sector's doing bad? If you can strip away all that, liquidity is probably the number one driver of where markets will go next. And you can see that with stock markets. You can see it to a lesser extent with gold and emerging economies. You can see it with a huge extent with Bitcoin. You know, Bitcoin is the number one liquidity play. When global liquidity ticks up, Bitcoin 83% of the time, Bitcoin follows that. But it doesn't just follow it linearly, it follows exponentially. So,
Yeah.
you know, as obviously a big Bitcoin investor, that's
course, yeah.
probably a big takeaway for me.
A couple of weeks ago, you wrote about the melt up, how you say the cycle will end with, rather than markets crashing, the powers that be will step in to drive liquidity. But what it will end up, it won't solve any problems. It's not going to solve the debt load. It's not going to solve the underlying erosion of purchasing power. In fact, it's probably going to make it worse. But it's just going to mean the liquidity drives to certain assets, which will cause a melt up. Is this what we're looking at now, or is this just yet another?
I think it is part of it. Look, for example, right? The one sort of theory about why the US cut interest rates more than what the market expected a couple of weeks ago was that they've got a lot of the US government debt is coming due over the next couple of quarters. And you've got to remember, the US government pays interest depending on where the Fed sets the rate. So if interest rates are higher, they're going to have to pay more interest on their own debt. And it's got to the stage, as we've talked about this before, it's got to the stage where
they're only servicing the debt now, aren't they?
They're servicing, yeah. $1 trillion of debt added every 100 days. And so it's in the US government's interest to have interest rates lower because they're the ones borrowing more than anyone else. And they need the interest rate to be lower. So part of that is, the argument could be made that the Fed cut rates with one eye on that rather than whether they should do it for inflation reasons or other reasons. They're actually just trying to help the US government manage their increasing debt load. Because obviously, as anyone knows who's got a mortgage, the higher interest rates go, the harder it is to pay off the principal even. And that's never going to happen with the US anyway. But the interest rate bill was getting so big. I think the interest rate bill in America is bigger or almost as big as the defense budget. So that's where we're at. So that is part of what I was talking about. The crash will be upwards, but it'll be of a necessity because they can't let the US debt grow so fast that it becomes so obvious that everyone just says, "Well, I don't want to hold US dollars," because you're essentially a country in default. That's not going to happen soon either. But that's the very real risk that I think the Fed and the central banks are worried about over there, which would have contributed to their decision to decrease rates faster than expected.
Yeah. It kind of leads into my final question about where all this is headed longer term. Now, you show a correlation table in your article today, which shows Bitcoin as having the highest correlation with changes in the global liquidity markets. Now, given the recent approval of Bitcoin ETFs, increased institutional interest, how do you see cryptocurrencies and I guess other assets, speculative assets fitting into a broader investment strategy in this new liquidity environment?
Yeah, well, that's the crux of the piece, isn't it? You have to have a strategy in your portfolio to take advantage of this liquidity as it comes into the economy. And so, yeah, like that's it's not necessarily a good thing, but they're going to print and they're going to put money in. And your wages or your fixed income, however you live, isn't going to keep pace with that money printing. And so you need to grow your wealth at a faster rate. That's the only way to protect your wealth from constant monetary debasement. And so, yeah, you need to look at things like Bitcoin, like stocks, like growth areas, like tech. They are the primary beneficiaries of liquidity. And that's not going to change, and it doesn't always make sense from a fundamental point of view. A lot of people get hung up, especially say with tech stocks, for example, that it doesn't make sense on a price earnings ratio or something like that. The market is not using the Nasdaq as a fundamental investment. It's using it as a liquidity sponge. It's using it as a way to protect their purchasing power over time, because that is the highest growth asset. Now you've got an asset like Bitcoin there as well. As you said, you've got ETFs now. you've got actors like BlackRock actively going on mainstream TV, telling people the same things I'm telling you today, that Bitcoin is a hedge against monetary debasement and growing government debt. You had Larry Fink on TV a few weeks ago saying that thing, which would never have happened 2 weeks ago. So now the equations is different. And this is what's interesting from a Bitcoin perspective. Coming into what looks like, in my opinion, a pretty favorable economic environment for Bitcoin in that high liquidity area. You've got Morgan Stanley's 15,000 advisors, you've got Fidelity, you've got BlackRock, all with the funnels to allow their investors to get Bitcoin exposure. And hardly any of these big institutions could do that in the past. So every other sort of bull run and cycle we had in Bitcoin and crypto never had that institutional money flow. Might have had a few sort of niche hedge funds playing in the space, but not the likes of BlackRock, Fidelity, Morgan Stanley, Bank of America. Now you've got that. So if BlackRock believe what they're saying, and you can see they're actually doing this, they're adding small allocations of Bitcoin to various portfolios, and they're expanding that across their range. And then there's this feedback loop that happens as Bitcoin rises in price. Other advisors who are not doing that need to copy them, otherwise they will risk underperformance because this is available to everyone now. So you've got a really interesting setup for Bitcoin over the next 6 to 12 months with this global liquidity. The risk to that, just to play devil's advocate, would be that there is some sort of global economic calamity, and as we know from gold, when there is a big panic, everyone sells off everything first and they move to the US dollar, and that would probably happen with Bitcoin too if there was like some sort of big, like we saw maybe a month ago with the Japanese carry trade situation, when there was that big, everyone was wondering what was happening and everything just sold off. Bitcoin wasn't immune for that either. So that's the risk. But barring that, if we're just in your stock standard central banks around the world trying to stop the stock market from being volatile, trying to manage the US government debt, and just trying to print the money that the US dollars and the money that the world needs, and just then liquidity trades are the number one way to play that over the next 6 months, I reckon.
Yeah, and I guess just as a final thought, I guess long term, they can do that. People can flood back to the dollar, but it doesn't change the fact that the debt load is just getting worse and worse. There's got to be some kind of jubilee, like
there'll be some day of reckoning. But people have been saying that for a long time. They devise ever more devious ways of kicking the can down the road. But I think I said this to Nick Hubble last week. It's like a game of whack-a-mole. They stop volatility here, but then it rears up somewhere else. They stop markets from being volatile, but what we're seeing is an inflation. Obviously, the currency being debased, like we've seen for the last couple of years. It always rears up somewhere. You can't stop volatility everywhere, barring some sort of 100%, panopticon control, like a central bank digital currency, which is a whole other topic, where they control everything you do. Markets and free markets, individuals are so complex that you can only stop volatility in certain places at once, but there's a cost somewhere else. And the cost right now is, to me, it seems they're willing to sacrifice volatility in markets and any sort of volatility in the economy. They're willing to protect that, and they are sacrificing the currency and the debt to do that. So that's the trade-off they're willing to make. And look, they'll kick the can down using various, mechanisms they can for a long time, as long as they can, and then they'll try and deal with that when the problems get, insurmountable, and try and deal with that volatility then. But that's the long-term story, and that's not going to change, and nothing can stop it really.
Yeah, good stuff. I think it's like the economist Thomas Sowell said. It says there's no solutions, there's only trade-offs, right?
Correct. Yeah.
But one thing we do know, the big print is on. Let's see where it goes. Ryan, thanks so much for your time today. I'll talk to you again next week.
Sounds good.